Hey Y family, my name is Nicolette Mashile, also known as the Financial Bunny. Today I will be answering all your questions that you have sent regarding your personal finances, your shmoney. Let's go. At Google Mabina _ wants to know, what is the recommended percentage of my salary that should go into my savings? So Google, the benchmark or the industry target is that you need to save at least 15% of your salary into your savings. But at the end of the day, it is called personal finances for a reason. You need to sit down and actually put together what is called a spending plan. Basically, your spending plan is your budget. So you need to sit down and write down what are your monthly expenses that you have to pay every single month for you to be able to survive. Then you need to write what are your protective expenses, right? So your protective expenses would include things like your insurance, your medical aid, things that ensure that you have the good quality of life that you want. And then last but not least, then you need to have a column for your savings. This way you will be able to see where all your money is going and how much of your money can you allocate towards your savings. So you will have a column with all your living expenses, and then your next column will be all your protective expenses. Once you've got those two expenses, you know that these are the things that you've got to pay for every single month. And then you've got to subtract that from your income, the money that you get every single month. If you're a freelancer and you don't get regular income, you can take 3 months worth of your income and average it out to a number. That number will become your income. You then need to subtract your protective and your living expenses from that amount, and you will see how much money you've got at the end. Once you've done this, you'll then know what is the percentage that you need to allocate to your savings every single month, because that is what is called your disposable income. Then what you need to do is that every month after the first time that you've done the spending plan, you now know that you can afford to put away 15% of your savings into your savings account, or 15% of your salary into your savings account. Just _ Nolonki wants to know, how do I know what a good investment is? All right, so a lot of people always ask about investments. Now remember, this is not considered as financial advice. What is an investment? Basically, when you are investing, you are hoping to get one, preservation of your funds. So however much you are putting in, you are hoping to get that. That's number one. And then number two, you also want to get it with a little bit of growth, right? So you're basically saying, I want to delay when I'm going to use my money, but when I do use it, I don't want it to look like how much money I had put away, right? And that's what differentiates savings and investing, right? So then what would make something a good investment? Something would be a good investment if, number one, it speaks to what is called your financial goals. What are your financial goals? Your financial goals are things that you are hoping to achieve that are going to need some sort of finance or money for you to be able to achieve them. So things like, maybe you want to go on a trip after 5 years, or you want to put a deposit on a car, or you want to buy your favorite sneakers. Those are financial goals. Now, some of them you can save for them, some of them you need to invest for them, right? Something like your education would be something that your parents would invest for you, so that when you reach the age where you go to where you need tertiary education, they are able to cash out an investment for you. So realistically, what you are looking for that is going to make a good investment is something that you can literally say, in the next 5 years, this money that I'm putting away today is going to look like this. Let me explain a little bit better using a car metaphor. You want to drive from Johannesburg to Pretoria. You know that you've only got an hour to be able to get from Johannesburg to Pretoria. Now, how do you want to get there? Do you want to get there as quickly as possible? Do you want to get there safely? Those are things that are important to you as an investor. So then you need to decide, what car do I go into that is going to get me there fast but also safe? Or sometimes you just want safe, you don't want fast, but you only have an hour to be able to get there. So a good investment would be a good car that can get you to Pretoria within an hour, because then you have achieved your goal. Your goal is to get to Pretoria, right? How quickly do you want to get to Pretoria? How fast do you want to go to Pretoria? And how comfortable must the ride be to Pretoria? That's what makes a great investment. A lot of us fall into the trap of wanting to chase returns, wanting to chase big returns. And unfortunately, when you do that, you also then take on the risk of potentially losing value in your investment if the market takes a downturn. For example, right now, the equity or stock market is going through the most right now, the absolute most. Why? Because the equity market has taken a downturn. So a lot of people that have invested their money into individual shares, some even into bundles or baskets or ETFs or unit trusts, which are highly invested in the share market, they're probably feeling it right now. Property is another asset that is feeling it right now. We talk about it being a buyer's market right now. The reason we say that it is a buyer's market is because people, ordinary customers and consumers, do not have enough money to be able to buy property at high prices. So, but on the other side, people that are selling houses are a lot. So the supply is high, but the demand is low. And the demand is low because people can't afford the prices. So what does that mean? It means that on the supply side, they are now forced to bring down their property prices so they can meet the consumer at the price that the consumer has. So they have to meet the demand at their price. And that's why property is another asset that is currently taking a beating right now. So what will make a good investment? The other thing that will make a good investment is a diversified investment. What does diversification mean? Diversification basically means that you are looking to invest in different asset classes and not just one. Because had you taken all your money and you had put all your money into the stock market, you would be panicking right now. But had you put your money into the stock market, into property, into bonds, government, retail bonds, into commodities like livestock, you probably would be in a better place right now, because all those assets are not all getting a beating. Some are getting a beating and some are not. And that's the beauty of the investing, is that not all the asset classes will take a beating at the same time. So it's very, very important for you to remember this. Becoming Mrs. I want to buy a car and property. After how long can one finance a car once you have financed a property? I'm afraid of having to pay off two long-term accounts, especially because a car loses value. Right. So again, remember, it is personal finances for a reason. So let's talk a little bit about the credit application when you want to buy certain purchases using a loan or credit lines. So what the banks do, or what the credit lender does, is they look at your credit risk assessment, right? They do a credit risk assessment on your name. This means that they're going to go and look at what is your affordability, number one, right? Can you afford to service a new loan over and above everything else that you've got? Does that make sense? So what they do is they go and look at your accounts, the types of accounts that you've got. They look at the income that you get every single month, and then they look at how much do you pay and spend every single month. Do you have enough disposable income for you to finance this new loan that you're essentially asking for? So that's step number one. Step number two, they're going to look at your credit behavior. So how have you been paying off the other credit accounts that you've got, right? And in that, they also look at, do you even have any credit accounts? So have you been paying any type of credit before? If you have not, then they don't know what is your credit behavior. If you have not been paying well, then you are at risk, because they don't know whether or not you're going to be able to service this new loan that you are potentially asking for. And if you don't have the right mixes, they don't know what type of responsibility when it comes to credit that you've ever had before. So they look for your affordability, they look at your credit risk, and they also look at your credit behavior in the past. Generally, most financial institutions look at your last 2 years, so your last 24 months, right? That that is what they look at. Then each and every single one of the banks or any other credit lender has their own credit criteria, also assessments that they then do internally. So if you have just purchased a home and you've taken on a bond account, what they're going to do is they're going to do an assessment again. If you are looking to now purchase a car, they will look again at your affordability, how long you've had certain accounts, how well you've been paying, and they will make a decision as to whether or not you're going to be handling or you will be able to handle an additional account that gets put on. So there isn't a formula to say after you've got a bank loan for a house, after 6 months you can apply for a car. If nothing has changed after 6 months of you taking on a bond account, if your affordability has not gone up, if your paying behavior has not improved, it doesn't matter, because you are not going to get that application approved, simply because when they assessed you the first time, that amount of money that they approved you for was what you could afford. Now it's easy for you to sit and do this at home. You need to calculate how much of your income do you spend every single month. 1, servicing debt, and 2, on your living expenses, and 3, on your luxury expenses. Then you need to see how much of a disposable income do I have, right? Let's say you do have a disposable income of 2,000 rand. Usala ka 2,000 rand every single month. Now if you want to buy a car, you must understand that generally it means that you can only afford a car that's probably going to be less than paying 2,000 rand every single month to the bank, because in all honesty, you only have 2,000 rand left after you've paid off your debt, you've paid off your living expenses, and you've paid off your entertainment. Very, very important. So some of these things you can do at home by yourself and kind of figure out, because at the end of the day, the National Credit Act says that financial institutions and credit lenders cannot be irresponsible when it comes to giving you credit lines. So when it comes to borrowing, they have to act in a responsible manner. If they can see that you cannot afford to service a new debt, they should not approve it. At Mafingo_Mshengu wants to know how can he start saving or investing for his son. The only thing that he's got an issue with is the fact that he actually gets a stipend and not a salary. Right. So I think it's important, Mshengu, that you understand that money is money. Investing is investing. The source of your income is not important as to where do you actually invest, right? I think that's the first thing that we need to get everybody to understand. So whether you are earning 20,000 rand a month or whether you are earning 2,000 rand a month, it does not change what you should be, whether or not you should be investing or saving. All of us should be practicing some level of saving and then investing. So the question that I'm going to ask you is, how much is your stipend? And how much of that stipend can you afford to actually put away for your son's education? Now, no amount is small for investing. If you want, there are many avenues where you can invest. So you have to ask yourself a number of questions. You've got to say, how much do I have to be able to put away every single month in savings or in an investment, right? The second thing you've got to say, what is my risk appetite? Right? What is my risk appetite? So am I a risky investor? Am I somebody who's conservative? Am I afraid of losing this money? Do I need a capital guarantee? What do I need for me to be comfortable enough that I will be able to contribute this amount every single month? And if something is to happen to the market or where I'm investing, I am not going to panic. Then the next thing you've got to ask yourself is, how long do I have before my son actually goes to tertiary or to university or gets an education? So if you've got 30 years, investing 500 rand a month is going to be different from somebody that only has 10 years. A person that has 10 years does not have the benefit of compound interest. So they then need to probably add in a little bit more. You, on the other hand, have 30 years. Then the other thing you've got to ask is, how much money do I need for my son's education? So somebody that needs 6,000 rand is going to probably invest a little bit lesser in a more moderate or a risk-averse investment than somebody who needs 30,000 rand in the next however many years. So it's important for you to ask yourself these questions, to say, number one, where am I going? What is the destination? Number two, what kind of a car can I afford to buy to get to the destination? Number three, what features of this car do I want? Do I want a fast car? Do I want a safe car? Do I want a reliable car? Do I want some guarantee, tracker, insurance, all those things, right? And then you gotta say to yourself, okay, now how fast do I need to drive to be able to get to that car? So what type of risks are you taking? So with an investment, it's the same thing. Where is my destination? How much money do I need to save? How long do I have to save? How much do I have to save? What type of risks am I willing to take for me to get to my destination in the amount of time that I've got? So those are the things that you've got to ask yourself before you can actually decide on what type of investment vehicle you should be taking up. At Becoming Mrs. says, hey Nicolette, I have just started trading on easy equities and I want to know how I can protect myself and my money. So first and foremost, investing is, and I don't want to say it's a gamble, right? Because it's not a gamble, right? And there are ways in which you can protect yourself. So first and foremost, when you are investing in the stock market, like you would be on easy equities, because easy equities is a stock market brokerage platform, right? In the olden days, if you wanted to invest in stock market, you would go on the JSE website and then you would find somebody that is a JSE registered stock market broker, and it would generally be a person. It would be like a Malum Tom, Malum Jonas, right? And you would say to Malum Jonas, I want you to please help me in investing in shares. So you would say, these are my goals and this is what I want to achieve, and Malum Jonas would make decisions on your behalf. But Malum Jonas would be working for what is called a brokerage firm, and what they would do for you on your behalf is to try and lessen any type of blows that you would feel if the market has a downturn. So they will actively manage your portfolio to be able to see when things that could potentially bring down the value of your portfolio would go down, right? Now what Easy Equities has done is kind of like a DIY platform where all of us who are novice investors are able to invest on our own. Now the problem with this is that not all of us have the right type of education, right? Now, I mean, I didn't study financial planning, I didn't study investment planning, so I have no idea of some of the reasons why the market would take a downturn, right? And that's a difficulty when you're doing things yourself, because sometimes you don't know how to foresee issues that are going to be coming up, so you don't know how to protect yourself. But it's also important to understand that when you have a strategy, your strategy is what is going to protect you in terms of you buying. Now, I don't know if at Becoming Mrs. is investing or trading, because there's a difference between investing and trading. When you are trading, it means that you are looking for opportunities at all times to buy and sell, to buy and sell, to buy and sell. So you're doing this on a daily basis. When you are investing, on the other hand, you are buying and you are holding for a longer term. So generally what would happen if you are trading, what we have on other platforms is what we call stop losses. So for instance, if a share price of Capitec, you bought it at 100 Rand and the share price of Capitec drops, you can put a stop loss to say if it drops below 90 Rand, the platform must sell for you immediately, right? So you've got what is called a stop loss. Now what happens is that so that's what those are some of the options that you've got. But if you are investing, you can have what is called an investment strategy. The reality is you are buying and you are diversifying into companies that have qualified, that meet the criteria of being JSE listed. Yes, there are exceptions like your Steinhoff, where there is a mismanagement of a mismanagement by the management or the executive in the company. And in those cases, Easy Equities has a product called InvestorSure, if I'm getting it correctly. They've got a product called InvestorSure, which is an investment fraud finance. And basically what it protects you from is that if there's any type of accounting irregularities, mismanagement by the executive of a company, and there is a loss on the share price or the value of the company, you then can institute a claim against that insurance policy. So it's the first of Easy Equity. So they've got that. But I think the most important way to be able to protect yourself is to rather invest in products that have some sort of capital guarantee. And once they've got a capital guarantee, what it actually means is that if ever something does happen, you at least get back the money that you have put in. Now, of course, you're not going to get the time back, and that's probably where a lot of people feel like they've been robbed. And I think also it's important to remember that the stock market, which is the asset class that you're going to be investing in or trading on Easy Equities platform, is a volatile market. Share market is very volatile, so the market fluctuates. The market responds to what is happening in the world in terms of, the economy, in terms of industries, sometimes in terms of politics, what's happening in the political world, what's happening at a specific company. So it's important for you to always be in the know on the companies that you are buying. And I always say to people, don't buy too many companies, because when you buy too many companies, it's difficult to track what's actually happening on your companies. And then the other best way to be able to really help yourself is, rather, instead of individual equities, rather invest in baskets, ETFs, or unit trusts, where it's a mix of equities, sometimes even a mix of asset classes, and you at least, it's that old adage of don't put all your eggs in one basket. If something happens on one side, at least on the other side you are still covered. See, Paul, in the long run, what is the difference when it comes to fixed interest and linked interest rates for home loans? Okay, so when you take out a loan, when you go to the bank and you take out a home loan, they're going to say to you, well, in actual fact, what happens is they're going to make you an offer, right? On the offer, it will say whether you've got a variable or a linked interest rate, or you've got a fixed interest rate, right? So generally, banks will start off by giving people variable interest rates, and if they're going to be giving you a fixed rate, they'll give you a fixed rate for a certain amount of time, not for the duration of your home loan. But what does it actually mean? So when you've got a linked or a variable rate, it is linked to the market and what happens in the market. So for instance, a couple of weeks ago, Lesetja Kganyago and the boys at the Monetary Policy Committee, they reduced or cut the interest rate. So they cut the repo rate, and when they cut the repo rate, remember the repo rate is the rate at which the Reserve Bank borrows money to commercial banks. So your Standard Banks, your Capitec, your FNB, your ABSA, your African Bank, and all the other commercial banks, right? So they too have an interest rate that they have to borrow at from the Reserve Bank. Remember, they don't just make their own money and print their own money. No, they're gonna borrow money also from the Reserve Bank, right? Then when that change happens, they also have to then cut what is called the prime lending rate, which is now the lending rate to us, right? Our lending rate. So now, when they change the repo rate, which then changes the lending rate to ordinary South Africans, it means that if you have a variable or a linked rate, because there's a change in the market in South Africa, it means that your rate also needs to change because you got a linked rate, right? But it works the other way around. So whether it's a cut, you will then get a reduction on the interest rate that you're being charged on your home loan. If it's an increase, your interest rate on your home loan will also increase. But when you've got a fixed rate, it's you saying nothing is going to change. Lesetja Kganyago and the boys are not going to be cutting any interest rates in at least the next 4 years. And then you take what is a fixed rate. Generally, a fixed rate is, it's always maybe 1% higher than what the variable rate is that the bank will generally offer you. Let's say, for instance, the bank says you will give you a link rate of 10%, right? And you like, actually, bank, I am foreseeing like interest rates being hiked in the next couple of months. So you know what? I will take 10.7 if you guys will fix it. Those are the things that you are allowed to negotiate. Generally, as I said, banks will give you a higher fixed rate than a lower one. But you must remember, banks are smart people. They've got a bunch of smart people that work there, right? And they know what's going. They can predict. They've got economists. They've got analysts. They can predict when there's going to be an interest rate cut or an interest rate increase. But remember, there's no guarantee, so nobody knows. So what is then the effect in the long run? The effect in the long run is that the lower your interest rate is, and the more you can lower it when there is a change in the market, the less interest you're going to pay. And if you've got a higher interest rate, the more you're going to pay. So, and other than us actually knowing or working with one specific account and looking at it over a number of years versus another one, I can't really give you the full effect of what would happen. But it's the same as, let me give you a better example, why family. If let's say, for instance, apples. Let's say the farmers sell apples to our supermarkets at 10 Rand. And they say apple, and the government is actually putting on a rule that farmers can only sell apples to the government at to the supermarkets at 10 Rand. Then the supermarkets all agreed to say, okay, sharp, if we're buying at 10 Rand one apple, we're going to sell it at 15 Rand, and that is the base of how much we're going to sell apples to different individuals. Now, of course, your price will be different from my price because of our risk, which is your credit score, your risk assessment in terms of how much you're buying an apple for, right? Now, let's say you go to the bank and you say, I want a basket of apples. I want a basket of 10 apples. And the bank says to you, because you've got a good credit score, we are going to give you a linked price of 14 Rand per apple, right? But if the government changes the prices, right, from how much the farmers sell to supermarkets, it means that your price is going to change too, because you've got a linked price, right? Then for somebody else who comes, they're going to say to them, okay, we'll give you a fixed price of 16 Rand per apple, and you're taking the fixed price. If the supermarkets, or if the farmers change, or the government changes the price for farmers to sell to supermarkets from 10 Rand, your price will not change. It doesn't matter how much they raise it. So those two examples. If the government wakes up tomorrow and decides, you know what, apples now need to be 20 Rand from the farmer to the supermarket. For the person who's got a linked price, the 14 Rand, you now are going to get 14 Rand plus an additional 10 Rand, which is going to now buy them at 24 Rand per apple, right? And for the person who's got a fixed rate, a fixed price, who was buying at 16 Rand an apple, their one will stay at 16 Rand because they've got it fixed. But remember, banks don't fix interest rates for long. They will fix them for a specific amount of time, and then you revert to a variable rate, or you can get reassessed again to see if you can get a fixed rate. Okay, thank you, bye.